What's up, everybody? This is Sunko, the Korean bro. Today is 2023, January 2nd. And let's see, okay? Beware, AT&T stock isn't as cheap as it looks. 3 dividend-paying tech stocks to buy in January. These 3 mammoth stocks have legitimate long-term upside. Okay. 3 reasons Nvidia stock could surge in 2023. Take Warren Buffett's advice. Don't buy any stock in 2023 unless it passes this test. 80% of Warren Buffett's portfolio is invested in these 7 stocks as 2023 begins. 2 remarkable growth stocks down 92%, 97% to buy before the next bull market. Why a new bull market is likely in 2023, and 3 stocks to buy to profit if it comes. 3 important 401k moves to make at the start of 2023. Wait, hold on. Beware, AT&T stock isn't as cheap as it looks. Due to its large debt burden, AT&T's enterprise value is more than double its market cap. Its debt also leaves it exposed to higher interest rates. AT&T's $93 billion in goodwill is further evidence that it has overpaid for acquisitions. Don't be fooled by the conventional metrics. Okay. AT&T is a telecom services company, and it's known for its service, and it's pretty big. And here it says, don't be fooled by the conventional metrics. Let's see why, okay? On the surface, AT&T stock has a number of attractive qualities. It offers a dividend yield of 6.1% and trades at a price-earnings ratio of just 7.5. As one of just 3 large telecom operators in the country, AT&T is also highly profitable. In its most recent quarter, the company generated $6 billion in net income on $30 billion in revenue, a reflection of its highly profitable mobility business and its status in an industry with high barriers to entry. Yes. However, even with its low valuation, high dividend yield, and wide profit margins, AT&T isn't the slam dunk that same investors might think it is. Here's why. A massive debt burden. AT&T's market cap is $129 billion currently, but the company is carrying $133 billion in debt on its balance sheet, giving the company an enterprise value, or what an acquirer would if it bought the company of $262 billion. The price-to-earnings ratio is the most commonly used metric for valuing companies based on earnings, but it's not the best one used with a company like AT&T that has so much debt. It makes more sense to use a ratio based on enterprise value like EV, free cash flow, for a capital intensive business with high capital expenditures. Free cash flow, a better reflection of the health of the business. And on an EV FCF basis, AT&T stock looks considerably more expensive. Okay, now what we know is that AT&T looks good on the outside, but if you look at it on the inside, they got a lot of debt. So you have to be aware if you are willing to interest much money into it. Mm. It's not as good as it looks. That's the point of this article. Next one we have is a three dividend paying tech stocks to buy in January. Microsoft offers broad diversification and huge profit margins. Taiwan Semiconductor dominates the industry and the stock looks cheap. Broadcom has a long history of outperformance and dividend growth. And we have Broadcom, Taiwan Semiconductor, and Microsoft. Okay, get the best of both growth and income. Microsoft. Let's look at Microsoft once again. It's well-known company and everybody knows because everybody pretty much uses the service that they provide, right? Let's see. Is one of the best performing stocks of all time, and it's easy to see why. It has dominated the enterprise software space for more than a generation. It is diversified across multiple product lines in a way that few other tech giants are. Its major offerings include its popular Office software suite, its Azure cloud infrastructure business, its Windows operating systems. Hmm. Popular Office software suite, it's what everybody uses, right? Azure cloud infrastructure business, and the company also has strong position in areas like gaming with the Xbox, social media, through LinkedIn, and a wide range of other software businesses such as GitHub. Hmm. Gaming with the Xbox, and social media through LinkedIn, and a wide range of other software businesses such as GitHub. So let's see. Xbox, LinkedIn, GitHub. Okay. Mm. Microsoft also enjoys massive competitive advantages as evidenced by its huge operating margins, which came in at 43% in its most recently reported quarter. The tech giant's dividend isn't going to turn any heads with its yield of 1.2%, but the company has reliably grown its payout over the past 15 years. More importantly, Microsoft's fast-growing cloud division and its diversification make it a good bet to ride out today's macroeconomic volatility. Mm. Fast-growing cloud division and diversification make it a good bet to ride out. Okay. While the company is sensitive to changes in business spending, there's little doubt that it would emerge from a potential recession just as strong as it is now and could easily gain market share from weaker software companies. A recession could also set it up to make some relatively cheap acquisitions, which would benefit it over the long term. So, some doubt because because of a lot of headwinds and interest rates, this company Microsoft would probably suffer the same way as uh, other companies do. But the important point is that they got a lot of competitive advantage, like the one we talked about, Office software suite, Azure cloud infrastructure business, Windows operating systems, and they got like strong positions in areas like gaming with the Xbox, social media through LinkedIn, wide range of other software businesses such as GitHub, most importantly, because I use GitHub. Uh, and let's go over to the next one. Taiwan Semiconductor. It's what I covered last time, but let's see again. Just got the Warren Buffett stamp on approval as Berkshire Hathaway bought more than $4 billion worth of the chipmaker stock in the third quarter, and TSMC passes the Buffett test with flying colors. The company manufactures chips on behalf of tech powerhouses like AMD, Apple, Broadcom, and others, and it has a wide economic moat with more than 50% share of the semiconductor foundry market. Hmm. On behalf of a tech powerhouses like AMD, Apple, Broadcom, and others. manufactures chips on behalf of tech powerhouses like AMD, Apple, Broadcom, and others. It's a wide economic moat with a more than 50% share of the semiconductor foundry market. Okay. Taiwan Semi is also a solid dividend payer with a yield of 2.4%. Its current share price, semiconductor stock sold off sharply in 2022, and TSMC shares fell along with the sector. But the company is more resistant to the cyclical nature of the chip sector than its peers because it's mostly immune to price shifts in chips since it isn't selling them to end users. Okay, so that means if it was sold to end users, it would be much more volatile to price shifts. But then they're immune to it because it's not like they're selling to end users; they're selling to enterprise level. The company has also posted strong revenue growth and wide profit margins recently. In quarter three, revenue rose 29% year over year to $20.2 billion, at the profit margin of 46%. Demand for semiconductors continues to grow, and TSMC is spending $40 billion on two new manufacturing facilities in Arizona, paving the way for significant expansion. The stock also looks well priced at the moment at a price to earnings ratio of 13, making now a great time to buy. Okay. So what I realized was that Taiwan Semiconductor, they are making chips for companies. So it's not like they're selling it to end users. So they're not volatile to the headwinds that we go through. And now what we have is Broadcom. Staying within the semiconductor sector, Broadcom also presents a good option for investors looking for dividend-paying tech stocks. Broadcom designs chips. It has avoided the headwinds that has impacted other chip makers since it doesn't focus on PCs and mobile devices. So PC and mobile devices are not their sectors, okay? Instead, Broadcom makes chips for data centers, wireless routers, modems, and other connectivity devices, as well as local area network infrastructure and fiber optics. Even in a difficult environment for semiconductor stocks, Broadcom has continued to grow its top line. In its fiscal fourth quarter, which ended October 30, the company reported a 21% revenue increase to $8.93 billion, and its adjusted earnings per share jumped from $7.81 to $10.45. Growth in income and recession resistance, it's hard to find a better option than Broadcom. Okay. Local area network infrastructure and fiber optics. Okay, Broadcom. Okay, now next one we have is NVIDIA. NVIDIA's data center business is booming. The gaming market is poised for a rebound. Management sees a $1 trillion opportunity ahead. Okay. NVIDIA shares were cut in half in 2022. Like many tech stocks, the semiconductor titan saw its growth slowed by inflation, concerns and fears of a potential recession, which drove consumers and business to pare back their spending on technology. But while the economic environment is likely to remain challenging in the coming months, NVIDIA's long-term prospects are tantalizing. Here's why the teammaker stock price appears set to rebound in the years ahead. A massive market opportunity. Okay, we have a massive market opportunity here. NVIDIA is a leader in accelerated computing. It's a graphics processing unit, excel rapidly processing large amounts of data. Excel rapidly processing large amounts of data. Excel processing large amounts of data. Okay. GPU, okay. It combines these high-performance chips with specialized software to further speed up applications. NVIDIA's accelerated computing systems, in turn, are powering some of the biggest trends in tech, such as cloud computing, artificial intelligence, and the metaverse. So, hold on. So, they got they are Excel and rapidly processing large amounts of data. Processing large amounts of data. And this will surely be used in many programs and like many part of industries because to power a lot of devices or to power computing, artificial intelligence, and metaverse, it has to it needs to have a lot of power, right? So NVIDIA's technology helps its customer better process and filter their data. It improves the image rendering and speech recognition capabilities, as well as their product recommendation engines. It can also be used to create virtual replicas of real-world items, thereby allowing customers to run simulations quickly and cost-effectively. Simulations quickly and cost-effectively. Okay. So when this author mentions a massive market opportunity, that means in the years ahead we'll use a lot of metaverse, artificial intelligence, and cloud computing, and power is a necessary source, and they're like the one that produces the power, so they got massive opportunity. Okay. So with so many users, NVIDIA's leadership passed its total addressable market at a staggering $1 trillion, with $28.6 billion in revenue over the trailing 12 months. The tech giant still has tremendous room for long-term growth. Okay. Cloud-fueled gains. And one another advantage they have is cloud-fueled gains. NVIDIA's data center business represents one of its largest expansion opportunities, data center. Okay. All the largest cloud infrastructure providers deploy NVIDIA's chips in their data centers. With more business shifting their processes to the cloud every day, due in part to cloud computing's cost, security, and reliability benefits, demand for NVIDIA's chips should rise steadily over time. NVIDIA's data center operations are already huge by most standards. With more than $10 billion in revenue in fiscal 2022, which ended on January 30. They're also growing rapidly. NVIDIA's data center sales surged 31% year over year to $3.8 billion in its fiscal third quarter ended October 30. With the global cloud computing market set to surpass $1.2 trillion by 2027, up from $545.8 billion in 2022. According to research firm Markets, NVIDIA's booming data center business is poised to become even larger in the coming years. The gaming market should rebound. So let's go over the advantages they have. First of all, they can make power source. And power source can possibly be used in many sectors like AI, metaverse, and computing. And the next one they have is cloud fueled games. They have big data center, and a lot of clients will use their data center. Uh, and its addressable market is huge. The last advantage they have is the gaming market. The gaming market should rebound for sure. Nvidia's gaming business has stalled in recent quarters, coinciding with a downturn in the personal computer market. If these issues are likely to prove temporary, the gaming market has grown to become an enormous global industry. There are now more than 3 billion gamers across the world, up from a $2.3 billion in 2017. According to Nvidia, the figure is likely to continue to rise in the coming decade as internet penetration rates increases and poverty rates decline. As poverty rates decline and penetration rates increase, a lot more population will use internet for sure. Moreover, each successive generation tends to have a greater percentage of gamers who also spend more time playing games. The gap has widened significantly over time, with members of Gen Z playing for over 7 hours per week on average, compared to 2 hours and 30 minutes for baby boomers. So Gen Z tends to spend much more hours in gaming. Mm. Partnerships with leading game console makers such as the one Nvidia struck with Nintendo to supply chips for its popular Switch gaming system have positioned the chip maker to profit handsomely from the gaming industry's growth. And when Nintendo's rumored to be gearing up to launch a new Switch device as early as the first half of 2023, Nvidia's gaming-related sales could be about to receive a boost. Mm. Nvidia is also the dominant provider of high-end graphics cards for the PC gaming market, with an 88% share according to John Petty Research. Its ray tracing technology, which can be used to produce incredible visual effects in games, is the most advanced on the market, making Nvidia chips popular among developers and gamers alike. Hmm. Okay. This author listed 3 reasons. Hmm. That all makes sense, right? Take Warren Buffett's advice: don't buy any stock in 2023 unless it passes this test. Uses a two-step process to evaluate any stock before it invests. While the Buffett test seems simple, it involves careful research and analysis. Two stocks appear to pass Buffett's test for 2023 are Oxygen Petroleum and Medical Properties Trust. So what are the two steps they have? Buffett. Buffett wrote Berkshire Hathaway shareholder in 2013 that he and his longtime business partner Charlie Munger uses basically the same approach in buying stocks that they do in acquiring entire companies. There are 2 steps to this process. Estimate the company's earning range for 5 or more years in the future. Company's earning range. Company's earning range. Buy the stock if it's available at a reasonable price relative to the lower end of the estimated earnings range. Buy the stock if it's available at a reasonable price related to the lower end of the estimated earnings range. It's available at a reasonable price. Okay. There's an important word that Buffett used with the first step in this process. Wrote that he and Munger had to determine if they could sensibly estimate the company's earnings. Anyone could plot earnings projections out of their air. Buffett, however, would insist that detailed research and careful analysis be performed to estimate earnings. Note that he specifies an earnings range be estimated. The multi-billionaire knows that it's impossible to precisely project any business's future earnings. The best anyone can do is determine a realistic range. The period of 5 or more years in the future is also key. Companies might be able to generate strong earnings over the short term, but unable to do so over the long term. Okay. And digging deeper, one obvious question about Buffett's two-step process is how can an investor estimate a company's earning range? The most important prerequisite is that you understand the company's business well enough to make an educated estimate. Buffett emphasized this in his 2013 letter, stating it's vital because, however, if we recognize the perimeter of our circle of competence and stay well inside of it, the best place to start estimating future earnings is to look at a company's financial statements. So financial statement is the first step here. Look at the current and past earnings to get a baseline. Check out the balance sheet to make sure servicing any debt won't hamper earnings growth. Examine industry trends and the competitive landscape. A company that dominates a market that's growing fast will be more likely to grow its earnings than one with a lot of competition in a stagnant market. Don't be reluctant to look at Wall Street analysts' earnings projections either. Just remember that the goal is to estimate earnings for at least 5 years in the future, not just for the next few quarters. There's also another question that needs to be addressed. What is a reasonable price related to the lower end of this estimated earnings range? This will vary based on the company's growth. However, the average price earnings estimate of the S&P 500 going back to 1950 is 19.6. A stock that trades well under this level compared to low and end of its projected earnings should have a reasonable margin of safety. Hmm. Okay. The harsh reality for investors eyeing tech stocks in 2023. Jobs data, 5 minutes, a fresh start. What to know this week? Worst stocks edge higher as darker forecasts loom. Okay. Fear is my friend. As an investor myself, fear is what I look for. And fear lingers in the article. Investors brace for more market tumult as interest rates keep rising. Okay. Tesla deliveries are coming. Here's what to expect. Okay. Four moves to make in your portfolio as interest rates climb. Okay. The harsh reality for investors on tech stocks in 2023. So you're probably wondering why I'm delivering morning brief newsletter directly to your inbox. Okay, let's see. We stumped a friend of the show, Mark, and underscoring how tricky picking tech stocks is at the moment. World stocks edge higher as darker forecasts loom. World stocks inched higher. European bond yields dropped and the dollar held firm in light trading on Monday. Following warnings from the International Monetary Fund's managing director, the third of the world will fall into recession 2023. Okay. Hmm. The stock market turned upside down last year when the Federal Reserve abandoned its easy money policies. Many investors say the ramifications are just beginning to ripple through markets. The central bank has raised interest rate to the highest level since 2007, stoking mammoth swings across global markets and a steep sell-off in assets from stocks and bonds to cryptocurrencies. The tumult that erased more than $12 trillion in value from the US stock market, the largest such a drawdown since at least 2001, is expected to continue as rates keep rising. Analysts at some of the biggest US banks expect the stock market to retest the 2022 lows in the first half of the new year before beginning to rebound. Those at Goldman Sachs expect the S&P 500 to end 2023 at 4,000, about a 4% rise from where it ended in 2022. The volatility has been especially punishing for the market's behemoths. Five big technology stocks accounted for about a quarter of the US stock market's total declines last year, a bruising sell-off reminiscent of the dot-com bust 2 decades ago. How to diversify? Okay. Hmm. So, what's an investor to do when interest rates are on the move upward? The Morningstar report offers several ideas. First, investors seeking to maintain a diversified portfolio may consider transitioning out of longer duration bonds funds into intermediate or short duration bonds. Hmm. We don't have that many interesting articles tonight. Anyway, happy Monday night and have a good one. Okay, bye bye.